Good afternoon and welcome to this week's weekly macroeconomics session for Friday the 10th of July 2015. Very pleased to have Jeff Saffer back on board. Jeff's had a little break last week with his family, so good to have his high degree of expertise sitting next to me this afternoon. It's David here. Hope you've all had a good week. Let's get underway with our macroeconomics session for this week. First of all, our disclaimer as always, and as it says, the content of this presentation or any other elite wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investment decision based on the general advice presented in any of our presentations, please consider whether it's appropriate in light of your financial circumstances. If you'd like to read the rest of the disclaimer, you can pause the video now and read it at the conclusion. A quick reminder about our Elite Academy coming up at the end of August, 28th through to the 2nd of September. Great venue this time around up on the Gold Coast. Hopefully we'll get some really nice weather. Certainly a lot better than Melbourne's weather, I'm sure. Certainly a great variety of topics, something that you can come along and choose your own topics, meet a whole lot of new people and a whole lot of new content, and that's certainly something well worth attending. Some beautiful scenes there, nice big pool, some free time available as well. You might like to have a massage or a game of golf, or just chill out and take things easy. The week in review, Jeff. You've come back from your break, and this week we've had a fair bit of data coming out in the Australian environment. We've had ANZ job ads, the cash rate, unemployment, and then culminating in the employment rate. And today we had home loans information coming out as well. So with all that data that's come out this week, Jeff, what's your summary of this news, and what's its likely impact?
Yeah, look, nothing game changing this week is the summary.
Yep.
Job ads ahead of schedule, so it's a good sign.
Yep.
After a fairly flat month the month before. RBA, no change, very little in their statement. Basically said rates are fine where they are and will only change if the economy takes a turn for the worse. Employment data was looked better than expected. So we've been saying for some time that unemployment is expected to rise. It's been fairly steady around the 6%, so it's been much more resilient than expected.
Yep.
But there's a few major resource projects about to wind up by the end of the year, so I think that still will climb in the next 6 to 12 months.
Yep.
Home loans was a surprising one. That's actually data for May.
Yes.
When we obviously had the rate cut.
Yep.
But owner-occupier loans dropped, investor loans dropped as well. Obviously, despite the rate cut, and maybe the banks have come out and put the clamps on lending a little bit. They've had been lent on by the regulators basically to slow things down to try and control the property market somewhat.
Yep. So just on that as an example, if the number of loans that are being initiated,
loan approvals,
loan approvals are being initiated is dropping, why is the real estate market still so buoyant, particularly in New South Wales as an example?
Yeah, this has this number has been fairly strong for some time. So the property market has been getting a lot of coverage in the last few months, but it's really been strengthening for a couple of years. We saw home loan numbers in 2013 go through the roof. I think up about 28%, up about 14% last year, and we're fairly flat this year.
Yep.
So that growth is starting to tail off. That suggests that the house price growth that we've seen is probably going to slow. Obviously, you generally take out a loan first and then you buy your house.
Yep.
So if we're starting to see loans slowing down, you should see house prices slow down as well.
Yep.
What was a minor thing, if you're reading into the data a lot, so that's actually the number of home loan applications fell 6%.
Yep.
The value only fell 4.5%. So even though there's less home loans, each loan is actually for more money,
right?
If that makes sense.
Yep.
As house prices are going up. So, look, I don't see much, to be honest, to suggest that house prices are going to stop going up.
Yep.
But I'd be surprised if they keep on going up as quickly as they have been in the last 12 months.
Yeah, sure, okay. And what about the impact of overseas investors? Is that, I mean, given that home loans, the number of home loans is reducing, but the property market is still rising, is that just due to overseas demand coming in, do you think, or is it something else?
Yeah, look, that's a decent factor. There's also a bit of a lag in terms of loan approvals and purchases and things like that.
Okay.
And there's also loan numbers used for refinancing and renovating and things like that.
Yep.
So that's part of it.
Yep.
That's definitely a big part. And just actually on that topic, obviously there's been a lot of coverage of Asian buyers in the Australian property market, particularly China. It's probably been, it's blown out of proportion. It's a nice story that gets a lot of headlines. Yep. And it gets a lot of people worked up. Yep. It's nowhere near the biggest reason why the Aussie market's going up, but it's a contributing factor.
Yep.
And maybe that what's been going with the Chinese market recently, that might draw back on that as well.
Yeah. Okay. And in the US, there we had trade balance in the FOMC meetings. Minutes last night, I think they came out. The trade balance there minus 41 billion versus 42.5 billion. I think that should have a minus in front of it as well.
Yes, it should, yeah.
on the slide there. Significant difference or not?
No, not too significant. It is good to see, though, that the trade balance was smaller than expected for the second straight month after a really bad result a few months ago. And tellingly, exports dropped a few percent, a couple of percent, sorry. We're continuing to see exports struggle in the US because of the high
dollar?
High US dollar.
Yep. Okay.
The FOMC, yeah.
FOMC, yeah.
Look, that didn't really raise much of a blip on financial markets in the last couple of days, considering what's been going on in Greece and in China.
Yep.
Again, they obviously it's the minutes, so we knew that the rates were on hold. This was trying to see the FOMC's thinking behind keeping rates on hold.
Yep.
A few interesting things to take out of it. Number one, there were a couple of members that thought rates could have gone up in June, that they think the US economy is ready for a rate hike. Having said that, those two members basically said, look, we think we're ready for it, but we can understand why we would still hold off. The FOMC also said that in future statements they're going to release a specific extra little section talking about what they're measuring before rates go up. And in reality, by reading between the lines, I think this is probably just pushing out the first rate hike potentially till the beginning of next year.
Yep.
They were also worried. They mentioned they were worried about Greece before it flared up.
Yep.
This is before China's meltdown got underway.
Yep.
So if anything, they're going to be more circumspect next meeting than they were this meeting.
Yeah, it's interesting just having a bit of a read through some of those statements and of recent times. I've sort of not being all that well versed in the fundamental side of things and what they're actually talking about. Just reading the actual statements, you get that picture that they're not too sure exactly what to do. What metrics are they actually looking at, and the timing for that, because they've got so much conflicting data and obviously worries overseas, that it seems likely that they're probably more likely to, like you said, extend that date out for when they're going to increase those rates.
Yeah, and they've shifted the goalposts a few times as well. So they started off by saying, look, when unemployment gets below 6.5%, we will raise rates. And then they got to that point and they said, there's still some weakness in the labour markets. When we see some more strength, and then they got some good data out and they started introducing some new language. So they're, in a sense, actually, in my opinion, they've been in the last 12 months, they've been coming up with excuses to push it back. And I don't see any reason. It has to be done fairly soon, but they don't really want to have to do it.
Yeah. Okay. And in China, their PPI, again, just remind us what PPI is.
So it's Producer Price Index.
Yep.
I think actually that's actually CPI numbers. So the CPI was up 1.4 versus 1.3, so a little bit ahead of expectations. PPI, Producer Price Index, so it's basically looking at wholesale prices. Took a big tumble, down 4.8%. That's been very strongly negative for recent times, based on the back of low oil prices, because that's a big cost in terms of building generating a wholesale product. But a little bit ahead of schedule, and last month was 1.2, so we're seeing a little bit of inflation in China.
Okay. All right. Well, let's go through and have a look at the markets now, how they've behaved this last week. Again, continuing our theme from before, certainly this extended channel to the downside has been respected on the upper band and also on the lower band as well. And it seems that no sooner do we get close to this top range that the market gets belted down again. Interesting that we had this pin bar formation yesterday, and today being a reasonably strong day on the market, moving back towards the upside. So hopefully we're getting near the bottom of certainly a rather large downward movement at this point. This horizontal line that I've drawn in here basically equates to the 2nd of January, which was the first trading day of the year on our market. And you can see that whilst earlier in the year we actually put on close to around about 10%, we've pretty much given all that back now. So the really important element from being in the Australian market is looking for those stocks that either from a fundamental point of view are offering good value. And Jeff, you've picked up quite a number of those, particularly over the last 6 to 8 months in particular, holding up well still. So certainly from a valuation point of view, the market still likes those. And from a technical point of view, picking stocks based on relative strength. Again, the Australian portfolio has had a little bit of heat this week, but still a number of stocks that are still holding up very well, given that the market's come back 10%. So that's a good sign for those stocks that we're in at the moment. It would be nice to see this market turn around and bounce back up to the upward side there, Jeff. And you'll notice as well that we are now in very high market risk territory. So really, you shouldn't be adding any new positions to your portfolios. Just continuing to manage those that you've currently got. If the market does turn around, then I think those stocks will benefit pretty quickly. Let's just go and have a look at the US for the time being. Again, the horizontal line showing where we were at the beginning of the year, Friday the 2nd of January. You might remember that the US market certainly didn't get off to the same start that the Australian market did. Our market actually was outperforming there for probably 5 or 6 weeks at the beginning of the year. We're pretty much back to square one over in the US market, and at the same time, recent market weakness seeing us now move into much higher risk territory. So again, if you're in US stocks, it's just a matter of continuing to manage those positions as you would normally, and that means using your trailing stop methodology. I ran a webinar on Wednesday talking about what to do when market risk changes. So if you haven't seen that recording, it's in the education portal. Sorry, it's in the section where the weekly analysis sessions are. Go and familiarise yourself with that, and I think that will help you in terms of understanding what you need to be doing in the current market climate. Jeff, I've got another couple of charts up here that I'd like to have a little bit of a look at as well. Before I look into some of the commodities, this is just the German market, obviously, again, still in that downward sort of trend at the moment. The Japanese market, which has been a very strong performer, again, more recently starting to see some big gaps and some big range movements again. And then we get on to China. So, Jeff, have you got any comments about this? I remember you making comments a few weeks ago with this sounding very much like a technician as opposed to a fundamentalist, seeing these big swings to the up and downward side and seeing a lot of volatility coming in, and saying at the time, I quite remember very clearly saying this looks like it's the sort of thing that you're expecting to see when you get to a market top. And here we are about 3 weeks later, and the market in China has been plummeting. So well done on acquiring some technical skills to start with in reading the charts. That's fantastic. From a fundamental point of view, can you explain why we've had this volatility and such an extended move to the downward side?
Yeah, look, the main reason behind this, first of all, thank you for giving me credit for that. It was probably one of my best picks, and certainly one of my best chart predictions in some time. The big reason behind this sudden drop-off is let's just ignore the last few weeks and then look at the rest of the chart.
Yep.
And you can see the Chinese market was up 150% in the last 12 months, and to an extent, the bigger they are, the harder they fall. And you can see what made me mention a few weeks ago that it looked ripe for a bubble and a bit of a crash is that it started off. You can see the candles at the beginning are so small,
Yep.
Not because they're so long ago, but just in terms of scale, because
Yep.
it started getting out of control.
Yep.
What actually happened is the Chinese basically encouraged investors to start taking out margin, or opened up restrictions on margin lending.
Yep.
Lots of retail investors got in, so they all started, and what we mean by margin lending, so basically borrowing money and investing into the market. And then two things happened along the way. So in early to mid-June, the Chinese cut back on margin lending levels, introduced sort of stricter regulations,
Yep.
and that basically means straight away, if you've borrowed, imagine like you've borrowed $1 million to buy a house. The bank wants 20% deposit, and then a month later the bank says, oh, you need a 40% deposit now. So you have to do one of two things: find 200 grand, which is very hard to do. What most people would do is they just sell the house.
Yep.
And that's what happened. So everybody starts selling their shares because they literally don't have the money to pay for them. And then, of course, once people start selling the shares, everyone else starts losing money, and their brokers start saying, you need to sell your shares, and it tumbles from there.
Yeah.
And so really just everybody that's made good money got out. Everybody that had borrowed money just had to just liquidate immediately. Interestingly, about a week ago, I mentioned this in my webinar yesterday, in Australia, if you're a company and you want to go into a trading halt, you have to write a letter to the ASX, and you have to say why. You have to say, look, we want to go into a trading halt because we are about to announce a takeover of a company. We are raising some capital. We have a major announcement that we need to release in the next couple of days.
Yep.
And the ASX has to actually approve that.
Sure.
In China, it's enough to go into a trading halt if you just think your shares are going to fall and you don't want people to be able to trade your shares. So we had, since the beginning of the month, I think 1,200 shares have gone suspended or into trading halts in China. And all that's done is it's just probably made things worse.
Yep.
Because if you've got 10 shares in your portfolio and suddenly 5 of them are frozen, what's your first impulse? Is to go, oh, I don't know if I'm ever going to get out of those 5. What's going to happen? Well, I've got these other 5 here that I can trade. I better sell those while I can. And I think that was probably counterproductive. Whenever I've seen any kind of market closing to calm things down, often it just creates more panic.
Yep.
And that was another factor more behind just why it got so crazy a week ago.
Yeah, yeah, it's amazing, isn't it? I mean, some of these down days, over the last week have been followed up by almost equally the opposite up days. So just real extreme volatility.
Well, yeah, I mean the market in the last 2 days, Wednesday I think it fell 6%, and then Thursday it was up 6%, and that was the biggest one-day gain, and I think the second biggest one-day loss in 2 days.
Yeah.
In opposite directions.
Opposite direction. Yeah.
So you've got to be on your toes.
Yeah, absolutely. A couple of other charts just brought up here. This is one iron ore. The price obviously has been in an extended downtrend for a period of time. Had a little bit of strength in more recent times, but just in the last month has really just fallen off a cliff. Why?
Look, a few reasons. Chinese, the data out of China has weakened. The supply coming out of Australia has increased.
Yep.
The falling Aussie dollar as well has had an impact.
Yep.
And it's just conspired to basically push iron ore. Look, virtually all commodity prices have come down.
Yep.
I think you've actually got a couple of charts ready as well, but energy prices have tumbled.
Yep.
And just worries about global growth as well.
Yep. So that's West Texas Intermediate crude oil at the moment. So obviously the price of oil is coming down, and copper as well.
So these charts are the last 12 months it is, looking
Yep.
at it. And if you go back to, say, iron ore,
Yep.
Obviously, that's the lowest it's been in the last 12 months. That's actually, I mean, just zooming out will give you some perspective. And we're lower than we were, during the GFC.
Yeah.
So iron ore actually fell a couple of days ago. It had fallen 25% in a week, 10% up last night. So we're going to see some more crazy.
So
trading
again,
there.
lots of volatility. Any danger of any major iron ore companies going out of business because of the price?
The smaller ones definitely will.
Yep.
I'd say most of the small to medium ones are at serious risk.
Yep.
I mean, they've seen their share prices collapse
Yep.
over a number of years, so it's not going to be a surprise.
Yep.
BHP and Rio are fine. BHP's pulling iron ore out of the ground at $20 a tonne, so at $48 a tonne, they're still making
money.
making money. I mean, a lot less than they were, but still plenty. Rio's similar kind of situation. Fortescue's in quite a bit of trouble. I was actually looking at something yesterday, and Fortescue have some bonds, so they've borrowed money from investors. They're paying that bond pays 8.25%. So if you would have lent money to Fortescue, they're paying you 8.25%. If you've lent Fortescue $100, until recently that was trading at $95. So the value of that $100 has gone down. Look, there's a bit of doubt that you're going to get your $100 back. Now those bonds are trading at about $75. And that means if you were to invest in that right now, you get a return of about 17%, which sounds fantastic if you get paid back. Once you get a bond trading with a coupon of more than 20%, it basically means the market thinks this company's going to default. So right now, if you lent money to Fortescue, and they paid you back, you'd be laughing. There's actually big question marks. The money is so big that there's question marks over you will get paid back at all, and how much.
So Fortescue might become a Greece. Is that what you're saying?
Yes. Yes. Risk of default. Yes.
Yeah, risk of default. Wow. Okay, so is Fortescue something a stock that you should have in your portfolio?
No, look, I have to put my hand up and say maybe a year ago I recommended getting into Fortescue. At that time, iron ore prices were a lot higher. I was expecting Fortescue to generate huge cash flow, pay down their debt, and then iron ore prices continued to tumble, and at some stage I got out and said, look, it's now too risky, and it's much riskier now than it was when I got out.
Yeah, certainly the charts are saying that, and they've been saying that for a long time as well. All right, so let's just jump back into our. We've had a look at the markets and just see what we've got ahead for next week. We've got in Australia a little bit of data there. Both banks coming out with respective surveys. The NAB with the business confidence survey on Tuesday, and then consumer sentiment on Wednesday. Any gut feel about those, Jeff?
Yeah, look, they're really interesting because last month business confidence was really good and consumer confidence was terrible. So consumer sentiment, I'll start off with first, has basically whipsawed month to month, and last month's reading was so bad. I think we'll get an improvement. I think it'll naturally kind of go the other way. So I'd be expecting a decent rebound in consumer sentiment, and I think consumer confidence should remain high. It was pretty consistent pretty much the first half of the year, very flat, slightly positive, and then last month we got a really nice boost. So I'd like to see business confidence remain high this month as well.
Yep. In the US there, we've got core retail sales and retail sales. So difference between those two again?
So core retail sales just strips out some of the more volatile items, like seasonal spending. Core retail sales was really strong last month. I'd like to see that continue as well. So somewhere around the 1% level. Probably won't make it that high, but sort of high, sort of single percent sort of range. Philly Fed Manufacturing Index came in last month, I think, at 15.4. So we'd like to see that continue to rebound. And CPI was higher than expected last month. I think that will probably follow through again. Consumer sentiment, again, that's been one that's whipsawed. A really good month, bad month, good month, bad month. It's the market and the experts haven't been able to pick that for months, and my best guess on that is just predict the opposite of what I did the previous month. It's worked quite well recently. Japan's a really interesting one as well. They've got monetary policy and a central bank conference. Look, they made a big announcement back in March with some bond buying that's really spurred their market on, and I think they've wanted to sit back and let the market do its thing and not intervene again. I think we'll see some. They're starting to see some weak inflation data, which is what they were trying to fight off. They were pumping money into the markets through bond buying, trying to get some inflation happening, and it's just backtracking. So I think there's a chance in, probably not this month, but probably in the next couple of months, they might announce some more bond buying,
right?
Which will get inflation going and the Japanese market probably taking another leg higher.
Yep. Okay. China, their industrial production, fixed asset investment on Wednesday.
Yeah. So these are two generally fairly crucial indicators of the general sort of growth phase of China, and they have been slowing almost every single month for a matter of years. Industrial production actually has been popped up a little bit higher the last couple of months. I'd like to see that even just hold its ground. Fixed asset investment will probably continue falling. That looks like it's never going to stop sort of contracting. And there's also quarterly GDP data out in China.
Okay.
And I think you'll find it'll probably come in around 7%.
Yep. Okay. Right, and lastly, in the Eurozone, the economic sentiment coming through from Germany there, and the ECB press conference. What do you think is going to be said at the press conference?
Look, I think they're in a similar situation to what I discussed with Japan.
Yep.
So they have announced a massive, earlier in the year, massive stimulus, and they wanted to then just leave it as is. Yep. The press conference will also depend on what happens with Greece.
Yes.
Which is looking increasingly positive after the Greeks came to the table with a fairly realistic proposal. Probably give them more credit than we expected them to. So that's a positive driver there. But again, there is a chance that the ECB might have to announce some more stimulus, some alternative asset purchases in the next few months.
Yep.
So again, probably not this month, but I wouldn't be surprised at all to see Mario Draghi splashing some cash in a few months from now.
Okay. All right. Well, it sounds like we need to just watch this space for the time being and see what happens and what the implications are for potentially that into the future. Well, that's the end of the session for this week, folks. Don't forget, Monday morning, 9 a.m. This week we should be able to run a full set of scans, given that we have Friday forming candles. Those of you in ETC will understand exactly what that means. So we'll be able to do our scans properly on the over the course of the weekend. So that's bye from me.
And bye from me.
And we'll catch up with everybody at 9 a.m. on Monday morning. Thanks for watching.
Have a great weekend.